Hello guys, hope I am on time this time. Okay, it's 9 o'clock, I guess. So for today's subject is trading stocks, risks and rewards, and it's Djellala Live 8 February 2020. Okay, so when we speak in general about trading, a lot of people they neglect risk. Okay, they want a stock that you buy, it goes up, and then you can make money. Yes, this is true. But what about risk? So the risk in investing and in trading, it's always misunderstood and it's always neglected. That's why traders, they have problems and they don't know why it happens to them like this. Okay, so hello Tony, hello Jocelyn, hello Fabian, hello James Armstrong. Thank you very much for coming. And as in general, if I tell you that trading is risk, is only managing risk, that's it. Okay, because whenever you buy a stock at any moment, at any day in the trend, before, after, stock is going down, stock is going up, whatever is your strategy, but whenever you buy a stock or you sell short, you enter to the risk. Okay, but before you buy, you have zero risk. So if someone tells you that there is a trade, that there is no risk and you can make money, he or she is the biggest lie on earth. It doesn't exist. Because the market, no one controls by himself the market. The market is so big. You go, for example, to buy Apple. In order that $1 change in Apple, you will see that we have millions of shares have traded. So millions of shares, you can find 20 million, 30 million, 50 million in a day. So it needs a lot of people to move it up or down. Okay? So if someone tells you, I know, he can never know what will happen. Sometimes even with earning news, as you have seen like Apple, it was good news, but the stock goes down. So risk is always there. Especially I have last week someone sent me an email and he told me how he knows the earning news, if it is good or bad. This is a very difficult thing, because when the people are listening to the news, it takes only seconds to make an opinion. If you are not a day trader, you don't have money, and you want to do like them, it will be impossible for you. Except when you have a very good broker, and the broker works until 8 o'clock. It means it begins with the market and closes with the market. And the brokers, they don't do that, except when they have a lot of day traders. Okay? But most of the brokers, they begin, for example, at 8 and they close at 5. It means if you are in those brokers, after, for example, 5, you can't trade, although the market is still open until 8. So do you understand that? It means the market is open, but you can't trade. It's not because they don't let you the exchange, but because your broker did not pay to stay until 8 o'clock. Because he has no, let's say a broker, most of his customers are investors and swing traders and the other stuff. So they don't need to trade. So he will not pay for the whole market hours, before hours and after hours, and then he doesn't make money. He should make money. So you should find some brokers that are specialized with day traders. Okay, they offer you this, but they know that you are trading. Or like before market hours, after market hours, they give you the news. Okay, they give you the news. They give you at any time something happened. They give you the news. So these are the work of day traders, and these are the brokers of day traders. Okay, so in general, whenever you buy something in the market, it means you own it. Like you buy shares. Understand that when you buy shares, you own these shares. When you own these shares, let's say you buy 100 shares of Facebook or Apple or Twitter or whatever. It means you own. You can even make, they can even make you a certificate. Okay? Certificate, it means that your shares will never disappear, except when there is bankruptcy. But you have this certificate. Before, in the old times, they have certificate of stocks. They buy these certificates, and it's a proof that you own some shares in a company. Okay? They send you a mail, by paper. Before, I'm not speaking right now. They send you all the information, companies' information and the other stuff, and how much are the shares, without looking at the papers, newspaper before, because this is what the people used before. Okay? Now, a lot of people, when they say risk, they think about stop loss. Now, here I'm not speaking about stop loss, because a stop loss is one of the obvious means of making managing the risk, but it is not the only one. There are a lot of stuff that you can do to manage your risk. Okay, so things you can do with a stop loss. Even the stop loss, you have many ways to do it. So I'm not going to go into details. But the people, they know, for example, most of the people, they know what we call percentage. But this percentage, I have explained it in my training. It doesn't work that much because stocks are different. Traders are different in these stocks. Some stocks, they swing a lot. So stop loss, most of the time, it doesn't work. So you should know how the stock moves. And even if you do the mistake, you buy again. Okay? And I'm telling you something that maybe some of you guys who have been new before, like many years ago, when you put a stop loss, most of the time, you exit on the stop loss, or you exit down a few cents. But 2 or 3 years ago, there is a change in the exchange. They don't accept any more stop losses. So the brokers, they try to use each software. They use the bid and the ask, and sometimes you find yourself that you put. For example, I give you an example. It happens to me. I call the broker 2 times or 3 times, and I discover the thing. Okay. Hello, Ziwar Rasul. Hello, James Armstrong. Hola, hola, hola. I'm not Spanish, but it's okay. So what did happen is that the exchanges with market makers, they don't want to respect the stop loss. For example, let's say you buy at $20. You put stop loss at $19. It means $1 down. It means you buy 100 shares of any stock. It goes $1 down. You lose $100. This is your risk. And then later you put 19, but tomorrow you find yourself that you exit at 1980. So you tell yourself, what the heck? What did I do? And then you ask your broker. Nah, he will try to, the bid is here and the either is here. So I don't say they lie, but the software cannot give you the price you want, because there is a change in the exchange. The exchange itself, like New York Exchange or Nasdaq, they change the way things work. And this is good for the brokers, because let's say 1 million put stop loss, you find 100,000, 500,000 for example, all their orders are executed. So who will profit from this? Who will profit? Everybody profit except the trader. I will tell you why. Now, when you put at $19 your stop loss, and you exit at 1980 cents, it doesn't matter when, it means which price, but the price is not good for you, because you think that the stock has gone under 19, let's say under 19, from 19 under, like 1895 or 97. So you exit at that because the price has gone to that price. But the problem, the price has not reached 19. It means no one has sold at 19. It is only that the bid goes down, because understand that those people who know level 2, you understand that there are a lot of bids and a lot of asks. But what you see on your broker, it means this is what we call level 1. Level 1, what does it mean? It means they give you the best for you, the best bid and the best ask. It means if you want to buy, they give you only one price of the ask. It means if you want to buy, or they give you the bid if you want to sell. Now, who will benefit from this random execution of stop losses? Who? So most of the time, most of the brokers will benefit from that. Now why? Because let's say they have 10,000 stop loss. If 5,000 are executed, they are lucky. Why? Because they make money. 5,000 by $5, $25,000 in just 1 hour or 2 or 3 or a day. But before, when the market was good, when the execution was good, only when the price goes to 19, or for real, it goes, and you see it. Now, how do you see it? You can ask your broker for the report of the trade, and you will see if the stock has really reached to that price. Now you find that the price was 1980 cents, not 19. And you say, okay, there is no price at 19 in order to sell at 90. There is no price, because today you will find your your stock has reached, for example, 1980 cents down. This is the low of the day. So from where this 19 come? It is this broker execution of trades because of their software. The software cannot understand what's going on because the exchange have changed, and they can't do anymore because before maybe you have heard, if you have been trading for many years, they have heard that they will not accept stop loss anymore. It's in that area that the brokers have been facing a big problem, because people, they want to use stop loss. Man, sometimes a stock is $20. There is a bad day, earning news in the day. At 9 o'clock it begins with 20, but it goes to 11 at the end of the day. So it was going down for a long time, for the whole day. So if you put stop loss at, let's say from 20, you put it at 1950, you can exit at 950. But if it goes to 18, to 17, to 15, this is a real problem. Okay? This is a real problem. Hello, James Dean. Yes, James Dean. Yes, it's very good. So this is a kind of problems that maybe you are not aware of. And right now, try to do stop loss and check what is the execution. Is it what you asked? Yes or no? You will find most of the time it is not. Okay? And you can ask the broker to give you the report and look at the report. What do they say? What is the low of the day? Because if the low of the day, this is tricky. If the stock is 20, it goes to 1980. It means it goes down just 20 cents, and then it goes up to, let's say, to 20 or to 21. Let's say it goes down 20 cents. Okay? So this is the low of the day. But you find yourself, you exit. Okay? But your stop loss is 19. It's not 1980. So this, guys, this is, I just would like to mention, at least you will be aware that stop loss now, it is not like stop loss in the before. Before, believe it or not, if you put, let's say 19, if the stock doesn't go to 19, no, you will never exit this trade. But right now, things have been changing. And the software that the broker use are not good anymore, because the exchange, they don't want to execute as it is said. Now, hello Nasa, how are you? So, who will benefit from this? All the Wall Street parties, brokers, market makers, exchange, and even the IRS or the FINRA. When you say to me, oh, all this, yes, because if, let's say, the broker, he's a big broker, and there are a lot of day traders. If all the orders are executed, but it's not correct, it's not the right thing, it means that the broker will make a lot of money from commissions. Okay, a lot of money from commissions. This is one thing. Now the second, the market makers, they will make more money, because a day trader, for example, he buys a stock, he put let's say he put the bid and the ask, and then he see that there are a lot of transactions. Any transaction for him, it is money. Now, what you see between the bid and ask is 1 cent, but understand, this guy is not doing only 1 cent. He is doing millions of dollars a day, because he's buying and selling millions of orders, and this is all by software. He will never do it by himself, because he can't. So all is done by software. So it is as if we are working with machines right now. It's not anymore with a human being like before, where the people are in the room or the trading room, and they put orders directly. A lot of in the past, in the like 20th century, the beginning of 20th century, almost all the people, they go there in order to buy by themselves. But this is for big traders, okay? And anyone who has money, you can buy a seat and enter. Okay, it's just like an auction. Okay, auction. It's just you raise your hand, you say yes, this, yes, and the price is going. That's it. That's how it works. And right now we still have this in New York Exchange only. New York Exchange, we still have the trading room, and the people, they buy a seat which is too expensive. I don't know how much right now. It's $2 million or $3 million in order to go inside, because there are advantages. Okay, so from this, let's continue. Who benefit? The exchange. The exchange, he has a part of the money. And then FINRA, or related to what we call the sale tax, or the IRS. The sale tax, it means there is a percentage of a share, not a percentage of the share. No, they put it like 0.00001 or 2. It means it is a small fraction. But understand that the whole market, with billions of shares, IRS or this tax are making a lot of money from stock market, although before it doesn't exist. So stock market, as I told you, it is Wall Street. It means Wall Street. When they say Wall Street, it is anyone who make profit without working, really, without doing risk. Now, for us traders and investors, we do risk. Whenever you buy a stock, you invest in a company, you are at risk of losing money. So the main thing is you understand what is this risk and how to manage it in any trade. And if someone tells you, for example, that there is a strategy when you buy something, a stock, and my strategy is zero risk, he is the biggest, or she is the biggest liar on earth. It doesn't exist. Because you can't control what the people do. Because how the price is moved by buyers or sellers and short sellers. So we have three actions in the market. There are some people who buy. Anyone who buys, you want the market to go up. That's why you buy. So when you buy, you manipulate the price and it's going up. Now, I'm not speaking if you buy 100 shares, but understand that, like you, we have millions of people, they buy 100 shares. Okay, so it will become billions of shares in the market. So these billions of shares move the market up. As you can see, each day in the market, you see some stocks move up, sometimes stocks move down. So this is the action of traders. So how can you know is your friend who is your neighbor, he is trading also? Maybe he is selling short a stock and you are going long. So one of the two of you guys, you and your neighbor, will win at the end of the day. Okay? Because the market moves only one direction at a time, but it can change its direction. But at least in the day, from 9:30 to 4, there should be a beginning price and an end price. Okay? So as I told you, the people who benefit from this thing is the tax. Maybe if you are not aware that there is a tax when you sell, okay? It's not when you buy. So this it doesn't exist before. So you are paying this. They deduct it from your shares. You can ask your broker, if you are selling something, you ask him about this tax. And you can know, for example, how much it is when you sell $5,000 or $10,000, $100,000, $200,000. You can ask them how much you paid for this tax. Although it is small, but understand that when you are trading the whole year, it will be some money. And this is how, and this is new. This is new, like a few years ago. So it means it's not something very, very old. But when I begin trading in 2010, this doesn't exist. There is no sale like tax or something like that. But when you buy, you don't have to pay any tax just when you sell. So in this, investors are better because they buy once and maybe he will never sell, so he will pay no money at all. Except when we have dividend, he will pay tax because he is obliged to pay tax on profits and dividend. That's why the people who will never sell, they invented this idea of dividend, because dividend, it is something taken from the price of the stock and given to you, but it is your money in real. Because a lot of people, when they read for dividend, I argue with a lot of people, but because they don't know what they are doing, they think they know because they have read it. So if you go online and, for example, you search for what is a dividend, now what did you read? You say dividend is a cash is cash from the profits of the company. This is not true. A dividend is not cash from the company. Company profits you will never see. This is from the capitalization. Capitalization, it means just the net worth. The net worth of the company is what we call the capitalization. What does it mean? Because it's very important thing. This is how do you know big company from small company. It's the outstanding shares multiplied by the price. Okay? So this is what we call capitalization. So understand that when they give you a dividend, it is your own money. I will give you an example to understand, because a lot of people, I spoke with a lot of people, they don't understand until they at the end discover that many years they are taking dividend and they think they are making money, but in real it's only your money. Okay, it's only your money. But when you have a lot of money, millions of dollars, you can see it is money. But it is from the stock itself. It's not the company who send you a check. The company doesn't give you money when you don't work for her. Okay, I will give you an example to understand this, because I don't want you to be confused with that. Let's say you work on the company and you have 401k. From where do they give you the matching of money? When you, for example, when you put $100, they match it, for example, $100. So let's say 100% they match. Let's say you put $100 in your 401k account each paycheck. So the company puts $100 more. So do you understand from where this 100 comes? It comes from the real money of the company, the profits. Because if they don't have money, they will not give you, they will not do a 401k. Some companies, they don't have a 401k because they can't afford it. Because the money, it comes from the cash of the company, the profits that they make each quarter. Now, in the stock market, you don't work for the company. So they don't give you any money. The money that they give you is from the stock. I will give you an example. Let's say the company in a year, the yield of the dividend a year is 5%. If the stock is $100, when they give you 5%, which is $5 for each share, now what does it mean? Tomorrow you will find your share is at $95. Why? They cut $5 and they give it to you for each share you own. Now you think that you are making money from dividend, but it is not. Because the price of the stock was 100. Let's say if you sold it at 100. Okay? So you have your own money. Now, let's say you leave it for tomorrow. You will find it $95 a share. So, if you sold it for tomorrow at 95, what does it mean? $95 plus 5 they send you in your broker as cash. How much you will have? $100. So it is your own money. Okay? But why the people, the investor, they like a dividend? Dividend is good because if you have a lot of money, especially people who are middle class, he works for 30 years, 40 years, he has $1 million, $2 million, $5 million. Let's say he's a doctor or he's a lawyer or so some people who make money in their jobs. Because there are some jobs that are highly paid. Let's say a doctor getting 200,000 or 150 or 300,000 depending on his job, or a lawyer or attorney. These kind of jobs. Okay? So this money, if he invests in the stock market, after 10 years, 20 years, he can have $5 million, $10 million as a 401k. Or if he invests by himself. So when they give him a dividend, it is good because he doesn't care anymore about how much he has. He will care about how much he gets without selling shares. Okay? So this is the good thing about dividend. So as I told you before, since we are speaking about dividend, now I understand. As I spoke about brokers and who makes the money when the orders are executed. And I told you there is a problem of execution. There is a real problem, and the brokers cannot fix it. And they will explain to you whatever things. Oh, they say this is the bid. The bid is $19. Yes, and we executed it, and it goes to 1980 because this is the price, the best price. No, it's not the best price. It is because the software doesn't know the exact price of the stock. They see, because the bids, they go down and up according to activity of traders. That's why you find some stocks who have a large bid and ask, because the market makers protect themselves. Okay, so they put it large because there is a lot of people who are like trading the stock. For example, penny stocks. Most of the time, when you see them, you find the bid and the ask is wide. So that's why market makers, they make a lot of money. Not the brokers. I'm speaking about market makers. Those they sell to you and they buy from you. These are called the market makers, because the broker doesn't sell and buy. The broker job is to send your orders to the exchange, and in the exchange we have market makers. These are guys who are working in the market in order to make money. So the exchange, they give them a percentage of what they make each day, and they work, and it is a job when there is no risk, so it's very good. So as I told you, since this session is about trading risks and rewards, we begin with the risks, at least with the stop loss, and I showed you that for the guys who just come, that there is a big change this year's, and they don't execute well the stop losses. So be careful when the stock is very not very volatile. It means the volume is very low. You will find that the bid and ask is very wide, and you can exit the trade although you don't want to exit, but the bid and the ask is so wide. Okay, let's see here. O2 said you can get profits if you buy a lot of shares. You can get profits if you buy a lot of shares. Now, do you mean dividend? Okay, I will give you an example. Let's say a stock in 1 year. Okay, I'm speaking about 1 year because you can't speak about 1 quarter. In 1 year, for example, the stock gives you 5%. So how much you make? O2. I'm speaking to you, O2. How much you make from $100,000? You will make $5,000. $5,000 is small compared to 100,000 you put in the market 1 year. It's small, and it is your own money. It's not the company that they send you this money. 5,000, it's just from your money. And I have explained that if the stock is 100 today, you sold it, you will have $100. Now, let's say another guy stay to tomorrow, and he sold it tomorrow. In the morning, when he wants to sell, the stock will be 95. Why? Because they take 5%. The exchange has taken 5% of the stock. So the guy who sold tomorrow is the same as you, because if you, for example, you sell tomorrow and you get the because today you hold, tomorrow you sell. So in their books, you are still an owner. Even if you in the X date you sell, you are still the owner. So in the books you get the $5. But the problem is that you are getting only 95 for tomorrow. They send you $5, so you have 100. And I, for example, I sell today 100. That's it. So we are equal. Okay, so don't understand. The only thing, people who invest, they are not looking for dollars. They should make their account big. Okay? They should make their account big. Let's say 1 million. Let's say after 30 years, 40 years, you have a good job and you are putting too much, like 25% or 30% of your money in the stock market. Let's say you reach 60 and you have $1 million. If you get $5 from your stocks, so what does it mean? $5 from your stocks, 5%, it means you will get $50,000 a year. Okay? And if the stock goes up, so the other year you will be making more dividend, more money from dividend. You understand that? 50,000, it means 5% of 1 million. But if you have a lot of money, don't tell me that you have $100,000 and you want to retire having $5,000 a year, and this is your retirement. This is not a retirement. 5,000. What do you do with 5,000? If you go to the hospital 2 days or 3 days, you will owe some money to the hospital. So don't forget about little money in your retirement. Okay, forget about it. You should have a lot of money to survive. Okay, I just give you an example. 1 million, you get 50,000. It's okay. 50,000 for those who are getting 100,000 when they work, and then now when they retire, they don't need a lot of money. Maybe they have paid their home, paid their car, paid everything. So 50,000 is very good for them. They can go and spend in some countries, Thailand or Philippines, or they go to South America, or they go to the mountains. They have money to spend. But if you have 100,000 in retirement, like 401k, if you begin to use it at 60, few years, this 100,000 will go because you need it. You need to take, for example, each month you say, oh, okay, each month I took 2,000. Okay? If you take 2,000 in 1 year, you have taken 1/4 of your money, which is around $24,000. It means your money stays how many years? 4 years. Let's say Social Security, they give you 1,000 or 1,200 or nothing, and you need $2,000 in order to live well, like $3,000 to pay your rent or to do some stuff. Or so if you are in a big city, you are not making anything, except when you go to the countryside where the land is so cheap and the housing is so cheap, and you will live cheaply. Okay, in order to that your money will be good. Okay, it's 41 minutes. Guys, I see your questions. Like Ramin Alazov, thank you very much, Ramin, for coming. I see your question. I will answer it afterwards. Ramin has another question. Yes, I see Ramin Alazov. I see your questions, but just wait for me until I finish the subject. Like last week and the other week, I finish whatever I want to say. Then you can ask questions, or you have a note. You have paper and a note, and you just note whatever thing you want, and I will answer your questions. Also he has another question. Ramin Alazov, he has another statement. I will answer all of you guys whenever I finish, and I begin with the first, because I begin with 02, and I will go to Ramin because he has asked a lot of questions. Please, guys, if you have questions about stop loss, about what is it else? If you have questions about stop loss, about dividend, about whatever question you have, please write it here, or no, you should write it. At least I will see it later. Now, as I told you, there is no only stop loss that you can use. You can manage your whole account. I told you always that you should not buy one stock in one account, only one, with all your money. Now, why is that? You have a big risk, but on the opposite side, you have a big reward if you make it for the trend. And this, some traders who are very, very exceptional, and they like a stock and they see it is so strong, so they make an opinion and they buy and they wait. But they understand the risk. The stock can collapse and they exit, yes, but most of these traders, they don't wait a lot to exit. But people who are not aware of the risk, if you buy a stock, it doesn't go up good, or it goes a few days good and then it goes down. They are scared to sell, and they sell always. Let's hold it for tomorrow. Let's hold it for next week. Let's hold it for next month. And they say, well, I read an analyst said that the company is good, so the stock will go up. So you are here giving excuses to yourself to stay. But you don't understand that if you lose 10%, the next week you lose maybe 20%, the other week 50% or 30%. And what if the stock doesn't go up? What will happen to you? You will lose your shirt. I'm telling you. If you are a trader, like swing trader like us, so you should determine, before you buy the stock, you determine where you exit if it doesn't work. That's the main rule. This is the beginning rule that you should always put in your head when you make stop loss. Even if you don't put stop loss in physical, you can put an alert. There are some brokers that they give you alerts. For example, you bought stock at $20 and you put $19 is a stop loss. It means $1 down. You can do what? You can do an alert from your broker at this stock at $19. But you don't have stop loss. You have an app, for example, on your smartphone, and when you are at work and you get the text message from your broker, oh man, the stock is 19, but it is real 19. And you just enter to your, very quick, in 2 seconds or 3 seconds, you enter to your broker account and you sell the stock. You can do that also, which is very good. This avoids the physical stop loss when you put it and you exit with not the exact that you specify. And this is a problem, as I told you, and I have explained at the beginning of the session, that it is a real problem now. You put 19 and then you exit at 1980. You don't want to exit at 1980. Because you calculate your risk and you say I will only exit at 19 because the stock can go down to 1980, 1950, 1940, but it can go up again. So this is normal in a stock. Okay? Okay. As I told you, the second thing in risk is account management risk. I have made, I think, training level 19, how to manage your account. Most of the people, they don't buy this training because they don't see anything in it. They say, okay, what's this managed account? Okay, I buy stock, doesn't work, I sell, I fake. Okay. But the problem is that when you don't know what you are doing, you don't know to calculate your risk not in the stock, but in the whole account. What will happen to you? You begin to see that your account is going down, but you don't know why. Is it just because of the stocks or is it of something else? You will never know until you see the things that are in the training, and that you see your mistakes. And most of the people, they realize their mistakes when they have no money at all. Many people, when they when they trade, mostly penny stocks. I have seen someone, I think last year, his account was $45,000. He doesn't know how to trade. He follows some people online, free thing. Free thing. You will never know from someone who has no training, no record, nothing. How can you know he knows how to trade? Most of the time they don't. And he has never traded, and he has never maybe made any dollar or any dime in the stock market. Okay? So when they begin to lose money, they have this trading fever, or what we call kamikaze trading. You trade, then you trade, then you trade, then you do another trade. and then you think stock is going up, you buy long, and then after 1 hour the stock is going down, you sell short. And because you are so mad at the market, you don't think what you are doing. So in the day, you can lose 1,000, 2,000, 5,000 without knowing that you are losing money. Because in trading, if you have a problem, psychological problem, or you have problem in your life or something, and you can't concentrate on your trade, do not trade. Trading is psychological. You should be calm. Before you buy, you should have some stocks. Not just you just go and you throw yourself to the first stock that you see. Okay? You should not do that. You should analyze your stock. You should prepare your trade before 9:30. Because 9:30 is just you see and you execute the trades. Okay? So it's not the beginning of the trade. It's the dead end. You should, for example, you want to trade first in the morning at 7 o'clock or 8 o'clock. You should see the news. What are the stocks that have news? Good or bad news? If the stocks have bad news, they begin before the market hours. They begin to go down. Okay, you will see that. You go to your broker or to online, and you will see the stock. For example, yesterday it was $20, but in the morning you find it's 19 or 18. There should be something that makes the stock go down. So the first thing you should do is search for stocks that have news. Okay, because most of the day traders use the news just to drive traders. Because the news makes people come to trade. And when there are a lot of people who trade, there is a lot of money. Okay? A lot of money. You see that the actions is very, very strong. I see stocks, for example, from 20, they can go to $30. 50% in few hours. Earning news also, it's a very, very big intensive for stronger market. You should be there where the news is, not the news of yesterday. Except when it is political or it is something, and it will be today's market. Okay, so understand that in training, you should understand things that people they don't talk to, because it is boring. For example, when I made my training about risks, about how to manage the account, it's boring even for me. I am making the thing, it's boring talking about these subjects. But this is the subject that you can make money from, because without understanding how to deal with your account, you are going to face problems in the future. And most of the people, it's not because of the stop loss that you lose all your money. No, there are other things. One of the biggest things is managing your account. You don't know how to manage your account. Okay? Now, this is the second thing I would tell you. So guys, those who want to see this training, please go to my website, which is Djellala.net, and you find I think the thing is 19. I will check it for you guys. Just you check it, guys. Let me see. Yes, it's 19, as I can guess. This is just a reminder. You can send me email if you want to. This is the thing that I told you about, and I can show you the thing about stop loss, which is another thing for those who want to check. If you have already bought it or you have golden subscription, don't worry about it. We have another thing. another thing that I'm speaking about right now, which is how to minimize risk. And you can just check them if you need. Let me give you my my email. Maybe you can send me an email if you want to. If you have any inquiries or anything, you can send me an email. And then I can proceed and continue. Okay. So, as I told you, so we have spoken about stop loss, very, very important. We have spoken about how to manage your account, which is the second big thing in risks. And there is another risk, news. A lot of people, they don't know the earning news. They have never searched when the stock has earning news, especially for the stocks that are so volatile. Why these stocks are so volatile? Why? Like Facebook, Apple, Amazon, Google, Tesla. They can move very, very fast up, very, very fast down. They have gap ups that are so big. And you ask yourself, why? Why we have this gap up and gap down so wide? And there are some stocks, we have the earnings and there is never change. Why? Because there are a lot of analysts, they speak about them. Some people, they get very happy to buy because analysts, they say, we are thinking that there is a gap up. But the problem, next day, they will have a gap down. So these people will lose all their money, thinking that an analyst will know the future. Because it's all about trading. When a company is well represented by analysts, let's say, for example, Apple, if you see the analysts, you find a lot of brokers that have analysts and speaking daily about Facebook, Apple. You will find some stocks, always they talk about them. So you say to yourself, why? Because they make tension in the stock market. They make the traders buy and sell. Now, who will benefit from that? All Wall Street. As I told you, the more people they buy and sell, who will profit? I told you at the beginning of the session that the brokers will profit because there are more buying and selling. There is more commissions. Market makers, they are making more and more money because when you buy from them. When you sell to them. So they will be making money from the bid and the ask spread. Okay? So they sell you more expensive and you sell to them cheaper. This is called the bid and the ask, if you don't know. There is FINRA, the tax, sale tax. It means any share you sell, you will pay some amount percentage of money of each share. It's like 0.0005 or something like that. You can ask your broker about this tax. But only when you sell, not when you buy. Okay? The exchange also will make money. So all these guys are what we call Wall Street. It means they make money without any risk. It's us, traders, investors, scalpers, option traders, futures traders, what we call the currency pairs traders, all these traders, Bitcoin traders, all these. Who will benefit? It's the exchange, it is the market makers, it is the brokers. They make clean money without risking anything. You buy, they make money. You sell, they make money. Whatever. Okay? So, the stocks risks are a lot. You can have from stop loss risk. You can have for execution and the other stuff. You have I spoken about trading management. I have given you two training. You can check them, or three was stop loss. We have a risk from news. This is the third thing I want to talk about tonight. News. Let's say one day you bought a stock, for example, you like it too much. Let's say it is you following me, and you buy a stock according to my strategy. But tonight or next week is the earning news. But you didn't do what I asked you to do. Is to look for the earning news when, and you decide to buy or to sell. Because when you hold a stock on the news, what will happen in the stocks that are volatile? What will happen? Either you make a big money or you lose big money. So it's like gambling. This is it. It's like gambling. If you like the high risk, you go with the earnings. But if you got a gap down and you lose a lot of money, do not blame the market. Blame yourself. Because the market, it's not only one person. The market price that you see is like a democracy. It's like a vote. Do you understand? Stock market is like the biggest democracy in the world. I vote, it means I buy a share. I think that Facebook will go up. So I buy a share thinking that Facebook is going up. So you have one vote. Now, somebody else buy another vote against you. He is a short seller. He is a short seller. He thinks that Facebook will go down. So he thinks he buy a share or he sells a share, which is like he buys a share. He sells a share. He is against you. So one of you guys will be wrong. Never. If you are both of you will be wrong. No, the market is only one direction. And I tell you always, for those who use options, he buys long and he buys puts and he say this is hedging. He begin to play like this and they say, okay, try to see at the end if you have made money, you will find that you lose money. Because you can't go into two directions at the same time in the stock market. You can virtually, yes, and you do it, but you will not make money. If you don't, most of the time you lose money. Because when something goes up, when it goes down, by options, it is not the same as stock. It doesn't mean that when you buy 100 shares of a stock, it goes $1 up. If you buy a put, you will have the same money. No, you will not have the same money because options is not going one down because the stock has gone $1 up. So understand this idea, because if you don't, options is another risk. So in this I'm not speaking about options risk because it has more risk. Okay. Now, hello Lighthouse Show. Hello NASA. So I will continue until I finish, and then I explain your questions and I answer them. Now, we have spoken about the news. And news, I told you, especially some news that you know, like earning news. Sometimes we have splits. When the stock, for example, is $10, tomorrow there is a split 1 to 5, or a reverse split. It means when just the stock is divided, or it is summed up, both directions. For example, a stock is $10 and the company thinks that $10 is small for them, so they want to combine 10 shares in one. So they put a reverse split 10 to 1. It means if you have 10 shares of $10, tomorrow you will see that you have only one share. Let's say you have 100 shares. Tomorrow, you will see you have only 10 shares. But your money is the same. But sometimes it will be very volatile. The stock will be volatile. It can go down, it can go up. So no one knows. So these are the risks. Another risk is about how many trades you do a week or a month or a year. This affects your account very, very much. So for me, what I ask my students always, when they begin trading, I say you should minimize the trades and according to your account, and you should calculate how much money you lose from commission. Because commission is an expense. Okay? It is an expense. Now, what does it mean, an expense? It means it is taken from your account. Either you make money or you don't make money. The broker has nothing to do with you. Even if you make millions of dollars, he will take $5 as a commission. He doesn't care what you make or what you lose. Even if you lose all your money, he has no pity on you. Or he say, oh no, he has lost a lot, so I will not oblige him to pay No, this is business. He doesn't care what you do in your account, and this is good. This is good, not that the broker or the government doesn't interfere for you what you are doing, because this is the biggest freedom, democracy in the world. When you do whatever you want, and this is another risk, because people, they think when there is a lot of freedom, it means you will be happier. No, sometimes you will be sad. Okay? And you will be worried. And some people, they don't even sleep at night because they have bought a stock that it is so volatile, but they don't know tomorrow what will happen. So because they are so scared, some people, they can't sleep. What if you have $100,000 and tomorrow in the morning there is earning news? So you will never know this 100. It is going to be 150, 120, 110. You make a lot of money. Or tomorrow you will find 50,000 and you lose 50% of your money. You will never know. So like these trades, there is a lot of risks. You should understand what you are doing. Understanding what you are doing is the basis for everything. And this is how you become an expert in the trading. How you have experience is just when you practice many months or many years. You will get this experience, and with training, you will know more. Because some people, I have been contacted with one. He works with a broker, and he told me, I trade for 10 years. I have never made money in a year of 10 years. But listen, I told him, okay, your problem, because he doesn't want to say that he doesn't know how to trade. He thinks he knows. But the problem, I told him, man, see, I'm telling you one thing. Since you are losing since 10 years, your strategies are false. And if you continue doing the same, you will lose all your money. In 5 years, 10 years, 20 years, whatever money you have, even if you have $1 million, you will lose it. It's just because you don't correct your mistakes. When you do a mistake and you know it is a mistake, you should not do it again. If you don't know it is a mistake, you should ask someone who knows better than you. But this is stubbornness in trading, and because of this freedom, you say, you find some people who have $5,000 or $10,000, and he go to do penny stocks. Oh, they say penny stocks. I see someone has some money, just 1,000, 2,000. No, he's millionaire. Now, why I don't make millions like him? So I should do the same as him. Okay. So he begins just to trade anything, And he goes to forums, he goes to chat rooms, he goes to Facebook groups, he goes to YouTube, he goes to guru that are hidden and I don't know. So he's doing a lot of strategies and he begins to lose until I told you about this guy. He has $45,000. Now, when he emailed me, he has only $5,000. I say, what did happen to your $40,000? He told me, I trade for 1 year and I do all the strategies and I was losing money. And then he told me, about your strategies, can I make my money back in a few weeks or 1 month or two? I say, what? You have 5,000 and you want to go to 45,000 in a few weeks, and the 1 year you trade, you lose all this money? This is impossible. I say to him, okay, if you are in the future, you keep your money, you get my training, and then you begin trade. I'm not saying safely, but you begin trading better. And then you can gain your money little by little because you lost too much money. It means as you cut yourself and you leave the blood going out until you faint and you die. Because your money, your cash money, is something very, very important in life. I explained last week. And some people, they like this what we call personal finance, because the people, they don't understand that when you have money in the stocks or in the savings or in bank or in anything, you have money that it is cash. It's not credit card. You are good. If something happened, you can use that cash. For example, you have an excellent job. You are making $100,000. An example. You have a house. You have a car. You have a nice girl. You have everything. Now, one day, you get fired. Now, in order to find a job, it's not easy. Some people, they stay 6 months searching. They don't find the same job or even better job. So how do you live? How do you pay the high, for example, your house is a single home and you pay $2,000 or $3,000 a month. How do you pay that if you don't have paycheck? How do you pay your car? How do you deal with your family? Expenses, utilities, mortgage, another thing. So, guys, you should have always some money like a emergency fund or your money or stocks that you can use them at any time. And this is a good thing for you guys. Those who know personal finance, they know emergency fund and the other stuff. Now, we have spoken a lot about risks. We speak about rewards in general. Rewards are good whenever you control risk. Although some people, they don't see any relation. You say, what's the relation with this risk and this reward? And I don't understand anything. Because I will give you an example in your life. Your paycheck. Your paycheck. I give you an example. Let's say you make $3,000 a month. Okay? If you spend $2,000 and you put $1,000 aside, like in an emergency fund, or what about someone who spent his $3,000 and he might need some money, $200, $300, $500, because he has a good job. He can put it in the card, and next month he can pay it. So you see the difference between these two people? Or let's say they have the same situation. One guy is not thinking about risks in his life, and the other guy is doing good in risk, in managing his money. This is what we call risk. It means you manage your money well. You should always keep some money aside And this, in some books, they say you should reward yourself. Here I'm speaking about in personal finance, general thing. It means you should always save money, always invest in the stock market. Stock market go down, but it goes up again. It's not like stocks, one stock or two or three. So by 10 years, 20 years, you will be making money for sure. Because this is what the market has done all the life. For example, you see, from 2000 to 2007, 7 excellent years. But 2008 was bad. But 2009, it was good, and 10, 11, 12, until 2018. So you understand that stock market mostly are good. Most of the time it's good. It's only 1 year or two in 10 years or 20 years that are bad. So don't think about the bad thing. Think to invest in good and bad times. Okay? So the guy who spent only $2,000 and he left $1,000, his reward is $1,000 a month. This is a reward for him because he didn't spend it. Now, after 1 year, 2 years, 3 years, he will have 10,000, 20,000. He can sell his car and change his car. He can take some money and go to a good vacation overseas. He can buy a small land. He can invest in something else. So he has an opportunity to make better choices in life. Because when you have money, you can do business. If you don't have money, you can't. Okay? It's very hard. For example, you come to the stock market, you don't have money. You have only 1,000, 2,000. And some people, they tell you, no. 1,000 is sufficient. 500 is sufficient. You can be a millionaire I see someone. I don't know how these people are lying, and they face the camera and they show to people, and you see that they are respectable people, but they lie. I have seen someone telling people on in YouTube that if you have $100, he can make it to 100,000 in 1 month. So understand that it is like doing MLM or doing some kind of scams. Yes, if you are doing scams, not trading. If you are going outside doing some, ask your friends some money and then you tell them the first will have this and the last thing will have this. Yes, these are scams. You can scam people, and you take their money and it's not true. So this has nothing to do with real thing. When you trade, it's something real. So reward in trading is that if you control risks, you begin to see results in your trading. I have one who is, he is not here today. He is from India. And in India, their money is so cheap. But he goes and he buys all my ebooks about swing trading. And he buys one. He asked me a lot of questions. He sent me emails each week. He tell me, look at our thing. I bought this, but why I did sell this? Why I lose this money? And then a few days ago, he told me, I begin to see the money, and I see your points when you're talking about something, about the market, about strategies. You will see these things when you grasp the strategy. But if you don't manage your risk, you don't have a strategy, you use any other strategy, just you go online and they say, how to day trade? Okay, do this. You go tomorrow and you will do it. You will lose money. Then you go to the next one. Do this. Because they don't teach you everything. They teach you a technique. It can be good one day, it can be bad one day, but since you are not good enough to decide, so you can't make money. You should need experience to use that strategy, or you should have you should have experience. You should develop yourself, because there are something that you discover yourself. There are a lot of people, day traders, they have only one stock they trade all their years. They don't change it. If the stock goes down, they sell it short. If it goes up, they go long. That's it. And they are making a lot of money because they know how to trade that stock. And they know the people that they are there. So they know a lot of stuff. So it will be very easy for them to master the risks and get a lot of reward. Okay? So guys, so let's begin with questions. The first question, O2, I have explained that. You say you can get profits if you buy a lot of shares, and I told you about dividend. Dividend, you should be an investor and you should have a lot of money. I give you an example. Let's say you have $100,000 and a year you got a 5% yield a year. Now 100,000, it gives you $5,000 a year. And you should pay tax on this $5,000. So ask yourself, is this investment, is this what you are looking for? To have $5,000 a year? So you say to me, no, 5,000 is not a big money. So what I ask you is you should make your account bigger and bigger and bigger. 200, 300, 500, 1 million. But don't be scared. Don't be scared, because investing is for the whole life. You invest because all your money will grow. It will grow in the future. Even if you have one bad year or 2 years, don't forget about it, because the market will redress again. And this is history. This is how the stock market is the best investment, better than gold and silver and bonds and these CDs and all the other stuff that you think about. Okay? Now, second, Ramin Alazov, he say, hi Karim, if you say dividend, it's not from earnings. If company has earnings and gives dividend from market cap, then next quarter returned earnings should be the same, but no lower. Now listen, Ramin, when they speak about definition, go to the definition. There are two kinds of profits. It's one profit. It is only one profit. But there are two ways to get the dividend. It means to get the money. There is one way is when you get the dividend from the stock market. It is different from when you get dividend when you are in your company. Yes, they give you the same dividend because the shares they give you some of these. But understand that I give you another example. If you are a worker, from where do they give you the profits? Okay? The profits. From where do they give them? If they give you a dividend, why they give you profits? Which is not dividend. Dividend is only when you buy a stock. But even if you don't own the stock in your 401k, for example, go to your 401k. You work for a company, but they don't have a stock where you own thing. Because if you own, they give you dividend from that own stock. Because the stock is $100, if they give you 5%, they cut 5% from that stock that you own. They don't give you from their money. But here is the thing. You work for a company, you don't own any stock. You don't own the stock. The company stock, you don't own it. You own what we call mutual funds, okay? But when you contribute each paycheck, let's say you contribute 100%. You contribute $100 to go to your 401k. Now $100, the company will match 100% or 50%. They will match your contribution. Now, from where the company brings that money? This money is not dividend. This money is the real money that the company has made. So you are still confused about the dividend. Dividend is given for the stock shares, but the real money is given for free because you work. For example, executives. You heard, for example, executive. I think the CEO of Bank of America, he got $26 million as profits this year. These are benefits from the company money. They give it to him because he is the CEO. You understand? $26 million. It is from the money of the company. It is not from the stock market. It's not from stocks. And I told you before, you should calculate that. Today, you have the stock is $100. If it gives you 5%, tomorrow it will be $95. What does it mean? It means they give you $5 from the 100. Then what is left is $95. $95 plus the $5 for each share they send it to you. This is 100. So it is your own money. They give you nothing. In real, they give you nothing. But you didn't sell to get this $5. But in real, it is just taken. It is just your cake. Do you understand? You bring a cake to your friend and he gives you part of it. It's all the cake is yours. But he just gives you part 5%. You eat it. So the cake will not be complete because you have already eaten 5%. What is left is the cake, but it is not the whole cake. This is the stock price. And believe it or not, if you don't understand, I can give you a proof from any stock before the X day. Check the price and check after. You will see that they cut some money from it. Okay? Now, Ramin said again, when the money goes from net earning, then listen, if you are going to, where is the net earning, the gross, the thing, you are going to fundamentals, and we are not dealing with that right now. Because you want to understand how the company works, how the company think. Now, this we are not dealing here. It's too complicated. I give you one thing that interests you. You should understand. If you want to do research about that, about the company, what does it do with its money? This you need to research or to read books to understand into details. But in the stock market is what I told you. Stock market is so easy. If they give you a dividend, they cut it from the price. That's it. And the price, it is your money. 100 today, they give you $5, 5%. Tomorrow you will find the stock at $95. And you have $5, so it is your own money. They don't give you nothing. This is just to pay tax. Because when they give you a dividend, you should pay tax because there are a lot of rich. Let's say Warren Buffett. I give you an example to understand. Let's say he gets 5% of his $100 billion. Okay? Do you understand how much he got a year like dividend? How much? He gets let's say he gets 5%. He gets $5 billion a year. $5 billion should be taxed. Because Warren Buffett, he doesn't want to have $5 billion a year. He doesn't want to. He doesn't need that much money. He said that what he takes is only $500 million. or less. I don't know how much or 500,000 or $1 million. It means he is not taking any money from the whole money he has. That's why his money grows bigger and bigger and bigger and bigger. He is not a person who spend too much money like the foolish guys of now, who spend all their money in 1 year or two and then he will be poor again. These guys know the value of money. So, O2 said salary, future investment and bonus for the board. Yes, they give bonuses, they give more salary, they give profit sharing like a 401k. The company gives a lot of money to workers and executives. Okay? But it doesn't give you money. She doesn't give you money. She doesn't know you. But she is obliged to take from the stock price, not from her money. Her money you will never touch, you will never see. But if you work for them, even if you don't have the stock, their company stock, you will have money. Ramin said, I understand that it makes sense, but if it goes to salary and etc., shouldn't we see that in income statement and in tax books? Can Karim open any large company with dividend and show the statement? Can Karim open any large company with dividend and show the statement? Listen, Ramin, send me an email. I will send you, try to check the X date of the company, before and after, and see how much they cut. They cut it after the market close. The stock is 100, they take 5%, you will find it $95 after the market close. Like at 4, 10 minutes or 5, you will find it. This is easy, but you don't. I know that a lot of people are confused, but for me it is easy. I searched a lot and I understand this. So if you can send me an email, I will give you an example. This, it has nothing to do with the company. This you find it in X date. X date and the price of the company, it's in the stock market, not in the company. Okay? Shopping Guide said, how much money do you make from YouTube ads and your education business? What? What did you say? How much money I make from YouTube ads and your education business? Now listen. You are asking about private information. Okay? But I'm telling you, YouTube, I am not making any big money. Any big money, it means it's not worth it. So the work I do here each week, and the thousands of videos, try to do them yourself. Go to the people who do stupid things. They are having millions of subscribers. If you go and you fart in the street and you put it in a video, you will get millions of subscribers than me. So you will be making thousands of dollars a month because of that. So you are asking about private information, and this is not good. Here in America, what do they say? If you are from America, Shopping Guide, if you are USA citizen, what is the proverb that you should put in your mind? There is a proverb you should know, if you are USA citizen or you were born here. The proverb said, don't ask a woman how old she is, and don't ask a man how much he makes. These two things you shouldn't ask. This is private. Okay? Thank you very much for your question. O2 said, that's why it's important to try to make a lot of money before you retire, starting a business to make millions. Yes, listen, you can do a good job, like a very high job, like you can make 3 figures, or you can do business. Either way. Okay? And all the jobs have risks, and the business have risks. You see big companies and they go bankrupt. Okay, so anything that you do in life has risk. Even if you do a job, going to the job is a risk, because you go driving by a car or by taxi or by train or by whatever you use as a means of transportation. You can have an accident. So there is risk even in going to your job. Okay? Tony said, my question, after you finish the subject, do hedge funds invest in China companies or foreign companies, or do they only invest in American companies? No. Listen, anyone can buy Chinese company. Chinese companies that are here, they are listed. Now, Warren Buffett, sometimes he buys Chinese companies and he sold them. But they are listed here. I give you an example. Alibaba. Baba stock. BABA. Which is called Alibaba. It's like Amazon for China. But it is listed here. So you can go and you buy Chinese companies. And if you use my stock screener, you can see the countries. But the countries, it means they have business in their country, and here they put their stock as listed here, because in America they can get a lot of money, and this money they can invest it in their country. Now China, why do they come here and they get listed? Because if he get listed in China, he will get little money compared to here. So when he lists his company here, he should provide the information of the company. How much they make, how much they change. They should abide with the regulations. They should say how much they make in the earnings, if they change the CEO, if they fire someone, if someone is selling, from the executive is selling, if someone is buying, anything that it does, the company should announce it to the stock market, and you can read it. So you can read any information, insider trading, what the executives are doing. You can do that. You can just go to the stock and you find insider trading, and you see the executive has bought 20,000 shares. Another executive has sold 100,000 shares. It means they do whatever they want with their money, but they should say. Now for you, if you buy shares or you sell shares, are you going to tell your brother or father or uncle that I sold? You don't, because it's your private business, or your neighbor. You don't, because it's your private business. But when you are doing public company, you are obliged to give information to the public, to the investors, what you are doing. Is your company doing good? If it is doing bad, you should tell them, because some people will sell. Although it is bad for the company, but there is no way out. You should tell them the truth. If the company is making money, it is good, you show them also, so that other investors will come. You see that? NASA said, some people make as much money as they pay in commission. Some people make as much money as they pay in commission. So what does it mean? It means if they pay $100 in commission 1 month, they get $100, so they are like equal. They don't make money, they don't lose money. Yes, maybe. I hope I understood your question, your sentence. NASA said, gaps in stocks are good opportunities for day trading. Yes, in day trading, some gaps, because it's so high, gap up or gap down, they find an opportunity to enter in order to make some bucks. They can, because it will be very volatile. And volatility is what the day traders like. They like a lot, because the direction could go very good in one direction for some time. This is what you need in day trader. You need a small trend in the day. like 15 minutes, half an hour, 1 hour, 2 hours trend. You need that in order to make money. But if it is 1 minute up, 1 minute down, you can't make money like that. So you lose money. Nasser said also risks from short sellers like hedge funds. Yes, I say short sellers also they have a risk, especially in the earning news and or because of the hedge funds. But understand that most of the short sellers are day traders, so they don't worry a lot, because when they see a problem they exit very quick. The problem is for swing traders, they do selling short. If you get caught in a good news and you are selling short, this is where you have a big problem. Okay? Andy, how are you, Andy? Hello, Mr. Karim. Have you seen Tesla's performance recently? Yes. I see it last week when someone asked me to buy. Listen, Tesla has gone from, I think from June last year, 600%. From 200 to 800 or 900, and now it goes to 700 or something. So, the people, when they see the big trend, they want to enter, but it is too late. So, my strategy is to find the stock at the beginning, not at the end, because at the end, I think one day the stock has gone $150 down in one day. So if you bought higher, you will lose a lot of money in that day. So it's not good to buy with the highs. It means which is not the highs. It is the percentage. 600%. What do you think the stock will go to? It can go, yes, but the probabilities are it will collapse. Okay? And someone asked me to buy. I say, okay, for me, I will never buy Tesla now. Never. In the future, maybe. But Tesla is so big. It was 900 just a few days ago, or 1 month or 2 months ago. Why should I buy a stock which is 900? 900 is too much. Like Google, like Amazon, like other big stocks, they are so big. Ramin Alazov said, so what are you saying? If the price of the stock stays the same and dividend yield is 2%, then after 50 years, I am going to have 0 shares. I guess you already explained. My internet is low. Oh, okay. Thank you very much. No. If it is taken 2%, Ramin, I will tell you this. If taken 2% this year, but 2%, like let's say the stock is $100. Let's say next year the stock is 150, 120. Let's say you take 2%. So it means you are making money from the price appreciation also. Okay? So you are still making money from dividend and from price appreciation. 2 things. And this is why the investor invests in stocks. Is 2 things. Mostly is because of dividend and price appreciation. Price appreciation makes their account bigger and bigger and bigger. Let's say you bought Tesla, just an example, okay? You are thinking, and one day you have $20,000. You find Tesla at $200, and you say, Tesla, they do cars and electric cars, and the future is good. Let's buy Tesla. And after 6 months, you get 300% because $200, 300%. So from 20,000, you find that you make $60,000. It's good. This is called stock appreciation. It means price appreciation. It means the price has appreciated, so your account is becoming bigger and bigger. But understand that, what is it called? Investors, they don't want to sell shares, they want to buy more. Because for investor, he wants to have the biggest account before retirement. Because after retirement, maybe he stops work, so he can just work again and put money again. But some people, they do. They work until 65, 70, 80. I have seen people who are still working at 80. They don't care. It means they don't know where to go. They are single. They have no family. So he has a small apartment. He lives alone. If he doesn't go out, he will be stressed, and maybe he will die because of stress. Okay? So he wants to work and to see people. That's it. Okay? Enoch Crystallian, he say, do you trade options? Yes, in the past I traded a lot of options, and now I don't, because I am concentrated on stocks, and I don't want more what we call more risk in options, so I am concentrated on stocks. But I have training about options, and like ebooks, and like PDF file. So I will show you one. You might be interested in the future. So I have a training by videos, and I have another ebook that I have no videos, but it is ebook showing you how to trade options by using my training, by using my strategies in swing trading. So I will show you this. Yes. It is called, if you go to this ebooks and you search for it, it is called How to Buy Exactly Call and Put Options. It's an ebook. So you can just check my ebooks that I have, and you can maybe get interested to check. So it is called, I will give you the title. It's number 8. It's number 8 in the page. Number 8. You can just check it. If you are interested, you can check it. If you have questions, you can send me an email. Ramin said, for example, if you have only 1,000 in your account, and by using your strategy, buying 10 stocks, only $1 or 2 contracts each, it's less risky, and you control more money with options. Yes. Here you are speaking about options. But listen, this 1,000 you buy, let's say you buy 10 contracts. Do you understand that you think that you are controlling a lot of money, but you don't think that you are first buying time? The value of your option is based on time. If you are staying 2 weeks, you are paying more. If you are staying 1 month, you are paying more for time. But the value is another thing. That's why in options we have 2 things: extrinsic value and intrinsic value. Intrinsic value is the real value of your money, of your contract. Extensive value is only the time you stay. But understand, let's say we have a gap down. Let's say we have news. Let's say, just an example, okay? I'm not saying a lot of stocks. But let's say you buy 10 contracts of the same stock. Tomorrow is the earning, you don't know. and instead you buy calls. You think that the stock will go up, but tomorrow you will have a gap down. Do you understand that this $1,000 will be wiped out and you will have only $50 or $20 for the time you stay? Do you understand that? It happens to someone who was here like 2 months ago. He has $12,000 in an ETF. It means of options. This ETF, it is a stock, but it is based on options. He doesn't know. Do you know that he lost 90% of his money? From 12,000, tomorrow I think he has 1,000 or 1,500. So options, you are risking 100% of your money. In the stock, you can choose how much you risk, but in the option, no. Okay? So try to understand that you might lose it all in one day. All your money, whatever you put 1,000, 10,000, 20,000, 100,000. If you don't know what you are doing, you can lose it in one morning. You can lose all your money. So options, it is not for the beginners. Now that's why I make my training, just to explain step by step what are the risks, and understand that why I am doing this stocks, risks and reward. Because if you don't understand risk, you will never be a trader. Okay? So this is just to have an idea that this is what you read, because you are influenced by what the guys are said. Oh, they say yes. Who give you this explanation that options you are controlling a lot of money with a small money? Who? It is Wall Street guys who created options. Now, when created options, they created to be against you. Except when you know what you are doing, you can make money. When you know what you are doing, you can make money. But if you don't know what you are doing, you lose. This is like a casino. When you go to the casino and you play, 99% they lose their money, except for the professional gamblers who have an idea how to exploit the system. They know. They have an experience. Okay? They know how to play with the system. But 99.99, you go play. Las Vegas, for example, all the people they go, they lose their money and they have fun. Because they like they like to be there and some are addicted to gambling and all. It's fun. So he take 5,000, 2,000, 10,000. He has money. He spend some nights. He lose all his money. Go happy to his home. Okay. Now he thinks about happy time. He doesn't think about the money. So these are the losers, the biggest losers in the market. Okay. Nasser said, I mean, they trade too much like scalpers, so commissions eat their profits. Yes, some people, when they do scalping, they buy and sell very, very quick, and they can lose a lot of money. But understand, people, they think they are smarter than the system. But the system is very hard. You should study. You should keep your money safe, and you trade just a little bit until you know what you are doing. And then if you begin to make money, what do you need? The problem, you need more money. Let's say you know how to trade and you have 10,000, but you wish you have 50,000, 100,000, 200,000. You wish you have it, because at that time you can make big moves. You can buy more stocks. You can make more money. If you have 10,000, for example, if you make 10% out of $10,000 and 100,000 and 1 million, which is better? 10,000, 10% is only 1,000. Okay, it is 10%, but it is only 1,000. But someone who has 100,000, he has money. If he makes 10%, how much? It is $10,000. $10,000, yes, it is money. $10,000, if you put it on 2 or 3 months, you can spend it on 2 or 3 months. You pay your mortgage, you pay your bills, you pay. So it's money. Okay? The more money you have, the better you are in anything. In investing, in trading, in anything you do. Even in life, the more you have, the more you are better. Because you can move faster, you can do a lot of stuff, you can see opportunities. Because why you don't see opportunities for business? Why? Because you don't have money. You are looking only for the job. The job, it means you should go to the job, come back for the job daily. If you are sick, you don't make money, so you have a problem. If you get fired, you have a problem. You see that? It means everything is related to your physical, to your movement. Okay? But if you are a trader, you have a lot of money, you can, or investor, you can do this from home. You don't need even to go outside. So, O2 said, if you start with 1 million and grow at 25% a year, it takes around 31 years to reach 1 billion. Now you are like Trump. He began with 1 million. He said only 1 million. Now who gives you 1 million to begin with? Okay, this is very, very hard. This is billionaires and millionaires. 1 million is something not very big, but for regular people, $1 million, even if the guys who are working high, good jobs, attorneys, lawmakers, doctors, physicians, all these guys, it's hard to have 1 million aside. It's hard. Exception for the big CEOs, the big companies, the guys who are CEO of very famous companies, or athletes, very, very known athletes, when they make 50 million or 200 million, like Mayweather. He made 200 million in half an hour. Half an hour, he made $200 million. You see that? That is the money. That is the business. But it is very hard business. So, guys, I have only 4 minutes. I should stop soon. So I have seen a question here. Ramin said, but I traded some options with a small account. I bought CSCO call next day because of Trump news. It gapped down. I lost almost all the money, but I had time and it was coming back. I put limit stop. Yes, this is what I am speaking to the guy, and he told me, what is the? Yes. You told me, it's you, Ramin, and you told me, and you control more money with options. And you said it isn't less risky. Yes, it's not risky. It is risky. Options has more risk in itself than stocks. And lost only 2 cents per contract instead of 90% money. And I lost it by mistake. Instead of typing 39, I typed 37. It hit my stop loss, but I have to still call brokers because it doesn't match. Okay. Yes, but if it is volatile, they will show you the report that this is what you get, because there is no guarantee you get the price that you put. I just explained this at the beginning of the session. If you are here at the beginning, I explained the stop loss brokers problem. You will never get that, and you get worse. Okay, guys, so we are at the end of this session. Thank you very much for coming. Thank you for all your questions. Those guys who have more questions, you can send me an email. I'm always here. Just go to each email or go to the chart to this chat now. You find my email, or you find it in any video. You send me an email and you explain to me what is your question, and I will be happy to answer you. Okay? So I'm trying to close it up. It was a nice live, and I tried to answer all your questions. And if you have more questions, you can ask them by email. And thank you very much for being here. For those who want to watch it again, you can see tomorrow in YouTube. You will find the live if you are coming late or so. And it's all about risk today and about reward. And the thing is, if you don't control your risk, you will never become a trader and you will never make money, because risk is everything. Okay, risk is everything, and this thing, most of the people, they don't know about it. They just trade until they blew up, or they blew out their account. And when it is done, they say, "Oh, how I lose this? What's the problem?" But it's too late. You should begin earlier. Okay. So thank you very much, and see you next week.